to Sai Life Sciences, and the management of the company is joining us today. Let's understand more from the company as well as what is their outlook going ahead. We are being joined by Krishnanam Raju, who is the MD and CEO, as well as Shiva Ramakrishnan Chittor, who is the CFO of the company. A very good morning, gentlemen, and thank you so much for your time. First of all, would like to understand from you that now that you are a listed company now going ahead, that you will be on the, what will be the growth driver of the company, what kind of growth that the company is factoring in at this point in time?
Well, thank you. First of all, thank you so much. It's really been exciting for us to be a public company now. It's a really important point of a journey. The company is really looking at expanding our business as we had declared. The entire ecosystem in India is set to benefit from the China Plus One strategy, and this is probably a very exciting growth cycle for the next 10 years in terms of India being a significant player in the global innovation ecosystem. And we will continue to kind of expand our capabilities both in terms of scale and types of disease and technologies we operate in. It'll be about both bringing in new customers as well as expanding our existing relationships. And I think we have a great platform to grow in the next few years coming forward.
All right, Mr. Kanumuri, I also wanted to, this is Shreyansi joining in the conversation as well. I wanted to ask you about the Biosecure Act, because that has been the talk of the town. If it does not pass, what kind of impact are you then penciling in, and what are the other opportunities that you're keeping an eye on then?
I don't think the Biosecure Act itself is going to be as relevant, but we have seen a substantial change in terms of momentum of both companies and investors looking for, I would not say even China Plus One, they're looking at China at least equal part player to Chinese capacity and capability. So I think whether the Biosecure passes or does not pass, the overwhelming feeling is that China and the rest of the world will not have good trade relations for the coming several years. And people want to make sure that they don't get caught in any situation where things are unpredictable. So we think this is going to, the bill pass or not, I think the deleveraging from China is real and sustainable.
All right, Mr. Chittor, I would like to come to you to talk a bit on the financials then, because if I see your journey from FY22 to 24, though there has been a stellar double-digit growth in your revenue as well as EBITDA number, but look at the move in the profit that has grown at a 265% CAGR. I wanted to understand that given that the margins have been in that 13 to 14% range, now that you have jumped to 19%, are these margins sustainable? Like going ahead, should we pencil in like more than 15% margins for the company? What is the outlook and what could be the likely drivers for the same?
Without going into a forward-looking projection, I think what I would say is that what you have seen is the impact of the effort that we have put in over the last 3-4 years in terms of placing our business strategically and in a differentiated platform. We believe that the way we have positioned our business, puts us in a unique position with, in terms of the Indian market, and gives our customers the ability to expand where talent is available, expand where capacity is available. And, based on this, we believe that the business is poised to grow. And as we had written in the document, we have, we have actually upfront taken on a lot of expense in terms of building this growth, whether it's a US operation or the UK operation. And we believe this will help us as we grow in the next few years.
Absolutely. And Mr. Chittor, I also wanted to ask you, because, out of the 950 crores, 700 crores is going to be used to be paying off the debt. How will the balance sheet then look after that? What are the kind of comfortable debt levels that you're also looking at for the company?
After the repayment of the debt, we will have a very negligible debt in the books. I think from an industry perspective, I think, as far as the year end, just based on the number that we are repaying, our debt will become, insignificant from a balance sheet perspective. But a general debt leverage, I think, is a industry-wide, people give you multiple numbers, but 2.5, 3 times debt to EBITDA is a reasonable number for people to look at. But that's just based on overall industry situation and what you have seen with players across.
All right, Mr. Kanumuri, if you can help us with your guidance related to the capex plans, if you can highlight more about your plans, tell us, are you in any need of funds right now?
If you look at our margins, they improved significantly and growth rates. So will have significant internal cash accruals going forward. So we will fund most of our expansion through both internal accruals and a combination of some debt as well.
Absolutely. I also wanted to decode the product portfolio that you have, because the company's product portfolio in fact consists of 120 products in various stages of development across preclinical, phase 1, phase 2, as well as clinical trial stages. Can you give us a little bit of an update on the same? What would be your product launch pipeline? What does that look like right now?
So we have mentioned, as of September 24, we've mentioned the number of products in late stage and commercial. The way we look at early phase, I think just given the nature of the industry and the success rate of these products, we typically start tracking products more when it reaches late stage or when it is in commercial, which is phase 3 and or later stages. That's really what we really track, because that is really what is much more meaningful from a longer term revenue perspective. We look at all of the other revenue buckets as a shorter term projects that we would do to kind of build our longer term pipeline. That's how we look at the overall business.
All right, and Mr. Chittor, lastly, if you can talk to us about some of your capacity utilization. Specifically, if we see, then your Bolaram Unit 3, the capacity utilization stands at close to 49%. Even your Bidar Unit 6 is at close to 12% utilization levels. Any reason that you can spot for such low levels of capacity utilization, and how can we expect them to scaling up?
So I think the unit that you're referring to in Bidar is a very small oncology facility that we opened for operations in August of 2024. So what you're looking at in the data that we have released in the book is 1 month data. And this is much more a finishing stage for a product with a very low capacity. As far as Bolaram is concerned, again, it's a very small capacity from an overall perspective. These are an internal intermediate site for us. Bidar will continue to remain our premium manufacturing facility that would, we would use for our customers. And I think if you look at an overall blended average utilization, our utilization will be around the 65% plus mark. So that's the average utilization. Actual utilization by reactor or by a site depends on products, depends on what you're actually manufacturing at a particular point in time.
Well, absolutely. Thank you so much, gentlemen, for taking time out and joining us today. Now, of course, congratulations on the decent listing as well, because now, even now, you see the stock eking out gains over and above that listing level that we've seen as well. But time now to...
If you like this video, then like, share and subscribe to ET Now.